Japan's currency wasn't supposed to move like this. Not in a single morning, not with this kind of velocity, yet traders watched the yen slip into a freefall so sharp it felt less like market pressure and more like someone had yanked a foundation stone out from under the G7. At that exact moment, Beijing issued a warning that didn't sound diplomatic at all. It sounded surgical, directed straight at Tokyo's weakest fault line. And while Japan scrambled to understand why its defenses were failing, China quietly flipped a switch in Europe's bond markets that signaled something no Western capital ever expected. The world's second-largest financial bloc was already shifting east, and Japan had just become the first casualty of the new alignment. China's economic war with the West has expanded beyond tariffs and manufacturing into a multi-front confrontation that now reaches financial markets, supply chains, and currency flows. Policymakers in Washington and Tokyo continue to insist that containment, decoupling, and reshoring will secure strategic control, yet nearly every major industry in the G7 still relies on Chinese capital, Chinese inputs, or Chinese demand. The contradiction is widening, not shrinking. The United States says openly that it wants China to fall behind in AI, pushing export controls on cutting-edge chips and chip-making gear that would traditionally cripple a competitor. But even that message cracked when the White House signaled interest in selling NVIDIA's H200 chips to China, a model more powerful than the previously approved variant. The move exposed just how entangled American tech remains in Chinese markets. With tens of billions in annual revenue tied to customers, Washington is trying to restrain. The uneasy truce between Beijing and Washington exists mostly on paper. Any disruption, from Russian oil flows to tariff repositioning, could trigger another round of confrontation. China knows this and has been calibrating its leverage. Rare earth shipments to the United States, especially the highly refined materials required for chips, defense systems, and electric motors, have fallen to around 6,200 tons in recent months, the lowest point since early summer. Meanwhile, exports of less processed oxides have risen. The message is subtle, but unmistakable. China controls the choke point that matters, not the raw ore, but the refinement capacity the West can't rebuild quickly. Hundreds of mines won't change that without the industrial knowledge needed to transform material into usable components. For the United States, the consequences are unavoidable. Rebuilding these supply chains demands years of spending and a willingness to absorb higher inflation and deeper deficits. Officials tout early signals of progress, like the first U.S.-made rare earth magnet produced in a South Carolina plant after a 25-year gap. The factory brought construction jobs and promised future expansions into the thousands. But every success story comes with a parallel cost, a long runway of government spending, public sector borrowing, and a political narrative that guarantees more inflation before any stability emerges. Reconstruction may eventually restore capacity, but it cannot compress a decade's worth of industrial loss into a 12-month cycle. Japan is watching this process unfold while dealing with an entirely different pressure. Its government surprised Beijing with the firm refusal to reverse its Taiwan-related position, doubling down at a moment when the region is already at high tension. China responded by promising serious countermeasures, a phrase that usually precedes targeted restrictions on trade, tourism, or industrial inputs. The last time China pulled this lever, over the Senkaku dispute, Japanese exports fell by more than £1 trillion. That episode ended without structural damage, but today's global environment is far more fragile. Supply chains are tighter, energy costs are higher, and exporters face tariff pressure from the United States alongside intensifying competition from China across Asia and Europe. Japan depends heavily on Chinese imports for its manufacturing base. Roughly a fifth of Japan's total trade involves China, spanning affordable components, raw inputs, and consumer market access. China, by comparison, draws only a small fraction of its total trade from Japan and can replace much of it domestically. This imbalance gives Beijing flexibility to pressure Tokyo with less risk of reciprocal damage. Even tourism, often overlooked, becomes an early signal. When China reduces outbound travel to Japan, hotels, retailers, and small manufacturers lose vital revenue, and the slowdown spreads into regional banks and local governments already weakened by demographic decline. At the macro level, Japan has financed its stability with rolling stimulus packages since 2020. For 2025, the spending surpasses 20 trillion yen, aimed at shielding households from inflation and supporting auto and semiconductor industries strained by U.S. tariffs and global supply shocks. But repeated stimulus expands debt burdens that were already higher than any other advanced economy. Japan's debt-to-GDP ratio, near 230%, forces lenders to demand higher yields, not because default is imminent, but because confidence in long-term recovery is thin. Companies then face rising borrowing costs, just as trade risks intensify and global competition tightens. These large-scale pressures translate into personal consequences quickly. A Japanese manufacturer facing U.S. tariffs must pay more for materials, absorbs higher financing costs, and contends with Chinese competitors undercutting prices in Asia and Europe. Adding potential Chinese retaliation exacerbates the risk. Managers planning inventory orders cannot predict energy prices, currency values, or trade policy conditions. And really, this uncertainty grows sharper as the yen collapses. Over the past 2 months, the currency has fallen from the mid-140s to around 157 per dollar. Investors interpret the slide as a rejection of Tokyo's stimulus strategy. When a major currency weakens this quickly, especially against a dollar already strained by global deficits, markets assume inflation risks will accelerate in Japan. The weaker yen raises the cost of nearly every imported good. Japan imports 80 to 90% of its energy, LNG, fuel oil, industrial gases, and each drop in the yen adds to production costs. Companies face narrower margins and higher consumer prices. Households pay more for electricity, heating, and transportation. The pressure becomes circular. Higher prices force more stimulus. More stimulus undermines confidence, and falling confidence weakens the yen further. Eventually, currency intervention becomes likely. But intervention requires selling dollar reserves to buy yen, draining a vital financial buffer, and creating a new vulnerability. Once a country begins defending its currency aggressively, markets watch for signs of exhaustion, and confidence becomes as important as cash reserves. Amid this tightening cycle, China is testing the global financial system with a series of bond issuances designed to measure investor appetite. The results have startled Western capitals. China recently issued $4 billion worth of sovereign dollar bonds and saw overwhelming demand. It then issued 4 billion euros in euro-denominated bonds, and global investors placed nearly 100 billion euros in bids. That's more than 26 times the amount offered, and the pricing hovered close to EU benchmark rates. Investors effectively treated Chinese sovereign issuances like near-reserve grade instruments. This level of demand implies several strategic consequences. First, China can borrow in the world's dominant currencies with costs comparable to Western governments. Second, financial sanctions aimed at isolating China may prove less effective than policymakers expect. Through Hong Kong, China can continue issuing dollar and euro bonds even if political tensions escalate. Third, sovereign wealth funds, central banks, and major institutions, many outside Asia, participated heavily in the buying. They looked beyond geopolitical tension and prioritized diversification away from Western counterparty risks. Investors still need dollars and euros for global transactions, but they increasingly want exposure held outside Western jurisdictions, especially when reserve assets have been frozen or seized in recent conflicts. China has also expanded its offshore renminbi ecosystem. Dim sum bonds issued in Hong Kong have grown from the mid-hundreds of billions of yuan to nearly 2 trillion within a few years. These instruments allow governments and corporations to raise funds without relying on the US dollar. The growth accelerated after the United States lifted interest rates sharply, making dollar borrowing more expensive for emerging markets. Today, those high US rates remain anchored by heavy deficit spending, prolonging global borrowing costs. In this environment, China's local currency alternatives look increasingly attractive. Asia's foreign exchange reserves, now near $8 trillion, reflect these shifts. Countries still hold large portions in dollar and euro assets, but many are rebalancing. They want currency exposure for trade, but want custody arrangements outside the Western banking system. China is positioned to supply these alternatives, offering dollar, euro, and renminbi instruments tied to its expanding financial network. Momentum moves quietly but decisively as more governments explore partial reserve diversification. The yen's collapse and China's bond triumph aren't isolated events. They're intersecting arcs that reveal a deeper shift in global finance. Japan's stimulus strategies collide with China's financial rise in ways that no G7 forecast predicted. And in the noise of currency moves and bond auctions, a subtle realization takes shape. The center of stability is no longer fixed. It wasn't the currency slide or the bond demand that startled policymakers. It was the recognition that both events were feeding each other in real time, reshaping the balance of power before anyone had a chance to respond. From that moment forward, everything escalates differently. Japan's decisions now unfold under the shadow of markets reacting faster than governments can coordinate. China's success in attracting global capital comes precisely as a G7 member faces severe financial pressure. The United States, meanwhile, continues to rely on tariffs that increase inflation while depending on the same Chinese markets it claims to counter. Macro forces hit micro consequences again. A Japanese exporter facing rising LNG costs must choose between absorbing losses or passing prices on to consumers in a market already stretched thin. A regional bank in Osaka calculates the risk of holding Japanese government bonds as yields creep up. A Chinese policymaker watches global demand for euro bonds rise and concludes that Western investors may be more pragmatic than their governments. Every decision feeds back into a system shifting faster than consensus models can track. The quiet contradiction at the heart of this moment is unavoidable. Japan seeks stability through stimulus, yet stimulus undermines its currency. The United States seeks strategic pressure through tariffs, yet tariffs fuel deficits. China seeks financial expansion through dollar and euro instruments, yet those instruments reinforce the Western currency structure even as they weaken Western leverage. Each actor moves rationally within its own frame, but globally, the frames collide. As the yen continues to wobble and China's euro bonds set new demand records, investors are left to interpret a landscape that feels increasingly unfamiliar. The safe harbors of previous decades are clouded by political risk, inflation dynamics, and the growing weight of Asia's capital base. Japan may attempt a policy reversal, or China may moderate its warnings, but the direction of movement is unmistakable. The gravitational pull of financial stability is shifting east, one issuance, one currency swing, one stimulus cycle at a time. And as Tokyo braces for the next market opening, there's a sense that the ground has already moved under the G7's feet. The financial system they built is still functioning, but its center of balance appears to be drifting toward the one player whose momentum hasn't slowed. The next shock may come from a bond auction, a currency intervention, or a retaliatory policy announcement. But the deeper change is already in motion. The architecture of global finance is beginning to tilt, quietly and irrevocably, toward a new axis. Please like and subscribe. Leave your thoughts in the comments. Your support helps us grow. Thank you.